I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on unusual lows. They push them on unusual highs. For someone that can sit back and have their own opinion, know something about an industry, this is a positive. I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on unusual lows. They push them on unusual highs. For someone that can sit back and have their own opinion, know something about an industry, this is a positive. It's not a negative. So that's what I want to talk about. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks.
If you're an institutional investor and want to invest successfully, Peter Lynch has laid out 4 things you need to do. According to Lynch, the cardinal rule of investing is know what you own and why you own it. This means that if you own a stock, you should have a deep understanding of the company, its products, and what separates the business from competition. Additionally, you should be able to explain to a kid why you own the stock. I remember the first time I ever heard this advice from Lynch. I was a college student and had just finished his must-read book, One Up on Wall Street. In this book, Peter Lynch talked about how even professional investors often buy stocks without really understanding the business or being able to explain why it makes sense to own it. At first, I thought there was absolutely no way this could be true. Professional investors are some of the most intelligent, well-educated people on the planet. I believed professional investors could never do something so foolish. Well, then I joined the industry myself as one of those professional investors and saw for myself just how true Lynch's words were. For background, professional investors have their investment performance evaluated relative to an index, often the S&P 500. The S&P 500 index consists of the roughly 500 largest companies in the U.S. economy. The index is weighted based on the market cap of each company, with the larger market cap companies accounting for a larger percentage of the index. This means that the larger a company is, the more its stock performance drives returns for the entire index. Let's use NVIDIA as an example. NVIDIA has a market cap of $1 trillion and accounts for roughly 3% of the entire S&P 500 index. While that may not sound like a lot, one company making up 3% of the value of an index with 500 companies is truly massive. NVIDIA stock has been on a tear recently, up 200% over the past year, as of the making of this video. NVIDIA is a technology company known for designing and manufacturing graphics processing units. The average portfolio manager on Wall Street is likely in their 40s or 50s with a finance background. Put another way, they aren't geniuses when it comes to cutting-edge technology. If a professional fund manager followed Peter Lynch's advice of only investing in companies they understand, there is a good chance they wouldn't have owned NVIDIA stock. Investors in this professional fund would likely be upset at him for missing out on NVIDIA. Professional investors are human. They have a mortgage payment every month and bills to pay. They want to keep their job, and to do that, they have to keep their investors happy, which often results in professional investors owning stocks they don't understand and owning them for no reason other than to make themselves look better to current and potential investors in their fund. Thankfully, individual investors don't have this problem. The only investor they have to answer to is themselves. Simply following Lynch's rule of know what you own and why you own it will put you ahead of most Wall Street investors. The second tip from Peter Lynch on how to invest small amounts of money is to focus on smaller companies. During his time running the legendary Fidelity Magellan Fund, Lynch was able to generate an average annual return of nearly 30%. A big driver of these impressive returns was his ability to identify what he calls 10 baggers. 10 baggers are stocks that 10x in value, and according to Lynch, these are the holy grail when it comes to investing. In fact, Lynch even went as far as to write, the very best way to make money in the stock market is in a small growth company that has been profitable for a couple of years and simply goes on growing.